According to Avgal, one of the largest VC investments that was done last year was backed by an Australian corporate venture capital firm, corporate venture capital unit, with a US $50 million investment round in big commerce, which was led by a syndicate which included Telstra Ventures. And Telstra's not alone in the corporate venturing space in Australia, as we know. Telstra is in good company. Optus, Westpac, NRMA, AMP, Woolworths, Wesfarmers, Coca-Cola, Fairfax, Cisco, and of course, in the last week, the announcement by AIG to launch a $100 million fund to focus on disruptive technologies. So more and more Australian corporates are playing an active role in the funding and the development of early stage technology businesses. So the data's clear. The number of corporate venturing units globally is up. The funding volumes contributed by those corporates to VC deals is up. The number of deals that they're participating in is up. Syndicate participation is up. And all of those things are a global trend. They're not isolated to the US or to anywhere else. So what is driving this growth? What makes corporate venturing so compelling? We talked earlier briefly about some of the specialised funds that were being built in the market in Australia. And I mentioned that these funds, whether it's the China-specific strategy or ones that have a tight sector focus, such as focusing on real estate technology, all of those specialised funds tend to have specialised teams with specialised IP, with specialised networks that are specifically relevant to that investment strategy. They tend not to be generalists. And the reason that's important is because one of the most valuable skills that a fund manager can have is the ability to assist their portfolio companies to accelerate growth. And that's not just about capital. That's about helping those portfolio companies to overcome the key challenges and to meet the key milestones that they need to overcome and to meet to grow their business through the seed journey, through the startup journey, through the expansion journey. And that growth journey, and everyone in this room will be aware of this, of course, is fairly predictable across technology companies. It looks a little bit like this. So this is how we like to look at it at PwC. If you break the journey up into three key stages, the seed stage is really a stage of ideation. It is the stage where you move from idea to product. The startup stage is about incubation. Once you have that product, you need two key things to get you to the next stage. You need technical validation, you need consumer validation. And then once you have that, you're in commercialization phase, which is the expansion stage. And this is where it's all about customer acquisition and scale. And if I break that down just a little bit, what emerges is really, really interesting in the corporate venturing context. At the seed stage, you'll see in the second part of that table, we look at the funding ranges and the level of risk. So obviously, as a company moves through these stages and de-risks its business by meeting these core milestones, it becomes more valuable, it can demand a higher valuation, it is more likely to get funding. At the seed stage, the key things you're looking to do are to test the assumptions upon which your idea is built, right? So ideas always sound wonderful until you test them with the market, right? So the first key milestone in the seed stage is to test those assumptions and determine whether they're right or wrong. Chances are, in every early stage technology company I've ever worked with, those assumptions haven't been exactly accurate. And there's always been tweaks that need to be made, then to the revenue model, the customer segment, or the product itself to get it right. And I'll give you some examples of that in a minute. So seed stage, test the assumptions and develop some sort of proof of concept, something that you can put in front of customers that they can use. At the next stage, at the startup stage, you're looking to take that beta product, that raw, crass, often beta product, and launch it with customers in order to determine whether or not anybody's going to buy this product. This is the stage that we call technical validation and consumer validation. You need some level of customer acquisition to convince any funding partner or corporate partner that that someone's prepared to pay for the idea and the product you've just built. And once you've got that, once you have a technical product that works and somebody prepared to pay for it what you estimate and have forecasted they're going to pay for it in your revenue model, then you're in a stage where you can expand and scale the processes that you've built. That's a very high-level summary, of course. It's a little crude, perhaps. Anyone who wants more detail on those phases, there are a series of detailed blogs on my LinkedIn page that unpack each of these phases in a bit more detail. But for the purposes of today's discussion, if you look at that journey and the milestones that need to be achieved at each stage, what becomes clear is that to truly accelerate growth of a company at these stages, you need more than financial capital. You need intellectual capital that is relevant to the product you're building in the sector that you're operating in. And what a solid corporate venturing partner can bring to that process is brand and credibility, customers and distribution, infrastructure and resources, sector-specific intellectual property and know-how, and networks and relationships. And obviously, capital across that entire cycle, and we're already seeing that from the very earliest of stages through Telstra initiatives such as Muru-D and others, all the way through to the Telstra venturing and reinventuring type models which operate at this expansion stage. So proactive value acceleration is a key part of every VC fund manager's investment strategy, must be. And you can see from this that corporate venturing, when they get it right, can give their portfolio companies a huge competitive advantage, not just by providing financial capital, but the intellectual capital necessary to fast-track breakthrough ideas into the market by hitting these key milestones. And we know this works because when you look at recent history, you'll see that a large number of the world's most valuable companies have corporate venturing units as their investor base, as their early investor base. And that early investor base, that corporate venturing synergy, has allowed those companies, in part, to fast-track their growth. So, how do you put together a corporate innovation and venturing strategy, and what does this mean for emerging technology companies? What does it mean for pure VC in the market?